Hey guys, welcome back. So today we're going to talk about journal entries and kind of go through the six scenarios with you and hopefully help make the connection between them. Okay. So there's six steps we want to look at. First thing that you need to look at is determine whether you're the buyer or the seller, right? Someone is either buying a product or selling a product. Remember, in the previous videos, everything we've been doing up to this point are been sellers, or sorry, service based. Right now, we're going to be looking at the transfer and how it affects our inventory. So the first step, number one, is we need to decide, are we a buyer or are we a seller, right? Second, we need to follow which scenario does it fall under? Are we returning something? Are we paying for something? Or are we buying or selling something? So that's what we're going to look at. And then last but not least, the math. So we need to look at the math. And it comes to when we're looking at terms for payments and that sort of thing. All right. So let's quickly look at them now, the six scenarios. So scenario number one is when you're selling something or buying something with cash, right? A simple transaction. You either go somewhere, you buy it for cash, or someone comes to you and you sell something for cash. That's scenario number one, if you think that process. The other option is very similar. It's the exact same thing, except instead of actually paying for cash, you just actually put it on an account. So you can say, can you put it on my account? Or you can sell it on your account. Okay? So there's no actual transfer of cash. So those are the first two scenarios. Almost identical, just follow one is cash and one is on account. Well, the same thing goes for the next two. The next two is if you return. So from scenario number one, if you bought something for cash, you would want to return it for cash. All right? That would be scenario number three. Scenario number four is a little different. And be careful of the wording here because depending on which textbook you talk about, it's return for allowance. So in this case, the product doesn't change hands, right? If number three, we'd actually return the product, then that would be returned for cash. Scenario number four is we're returning for allowance. So for example, if you were to buy a keyboard for your business and it doesn't work, and you call up the vendor and you say, hey, my keyboard doesn't work anymore, and they say, no problem. Tell you what, don't ship it back to us. We don't want the product back because it costs too much. So in this case, next purchase that you have from us, we're going to offer you a 10% discount or allowance onto your account. So that's what that is. So the product doesn't move. We're just getting a discount maybe further down the road to go onto our account. All right, does that make sense? Because a lot of companies, it's not worth shipping product for them to look at, especially now with social media these days. When a lot of companies, they'll actually be destroyed for credit. They call that. Just take a picture of it, throw it the product, and then you'll get the credit or the allowance onto your account. All right. So those are your first four scenarios. So you think of it. There's the buying and the selling. There's the returning of the product. Um, Except for number four, we actually don't move the product. And then the last one is how you pay for it. So when you bought something, you generally in business, you get terms. So hopefully the seller in this case will create these terms. So encourage you to two things. One, to pay for it sooner to make sure they get the money, and also to buy their product so you can get a discount because some vendors you may not get a discount if you pay early. So it helps you with that. So depending on the contract, when you get the terms, you'll have these next two scenarios. So scenario number five is you paid for it, but you missed the discount. It's past the 30 days, past the 60 days, whatever the terms were that we talk about in the next video, explaining it more. But if you've missed the terms, you haven't paid by a very certain time, you don't get the discount. Scenario number six, yay, you did. You made the terms, you paid it. Say if the scenario was the discount within 30 days and you pay it off in 20 days, you get the discount. So then you have to record that discount. And that's it. Those are your six scenarios. Okay? So you're buying or selling, you're returning, and then you're paying for it. So if you think of it that way, that'll help you walk through the scenarios when you're thinking. But the very first step, again, is deciding first, are you the buyer or the seller? And then you're going to go through the transaction. And the video after this will kind of put it all together, so hopefully you help visualize it better. All right, let's look at that now. Go through the six scenarios. 1, 2, 3, 4, 5. I like doing this way so you can visually see everything onto one piece of paper. And then in the next video, it goes into going through specific examples and then actually working through doing the transactions in the following video. But I wanted to introduce you to this. It might help visualize what's going on. So in the first one, we're either buying or selling. For with cash. With cash. Second one, again, two options for buying or selling. On account. So kind of similar if you have a credit card, but you would have an account because this is business to business. Then your next option. So these are your two options of buying or selling. That's pretty much when we're looking at compared to the inventory. The next one would be return it for cash, the way you paid for it. So we're undoing this transaction up here. And the other option is return for allowance, I like to call it for, or return on credit, where the product actually doesn't get, where the inventory doesn't actually move. You're just getting a credit, and that's what happens with that one here. But I like to think of it this way. So you have two buys or sells, the two returns, so that completes the transaction. And then the fifth and sixth is the payment recording. So you paid, but you didn't get the discount, and we talk about it in the next video about the terms, like net 15 and so forth. So paid and no discount. And the sixth is paid, but you got the discount because you met the terms. So therefore you got the discount when you paid for it. All right. So those are your 6 scenarios, and I like breaking them in so you can kind of see combining these two, and now you kind of combine these two, and it helps you remember them, the scenarios. And then you can kind of walk through it. So in this case here, we're going to look at the accounts if you were the buyer. So within a buyer, you're going to look at inventory first and cash second. So thinking about, right, inventory, if we buy or sell, depending on what we are doing, inventory would go first and cash second. And then inventory, if you're buying by account, right, here we paid with cash. So if it was on account, it'd be accounts payable. So these are pretty straightforward. We're following down, right? Inventory is an asset. So it would be going up if you're buying it, right? Return for cash. Now you purchase these either with cash or an account. So if we're going to return something, it'd be accounts payable. And inventory. So now our inventory is going down if we're looking at just being the buyer. Return for allowance or credit, so it would be accounts payable as well. But the inventory doesn't go anywhere. It would stay the same. So your inventory gets adjusted, even though the inventory would stay the same. And we explain that more in the video. The inventory doesn't go anywhere, but your cost for your inventory is adjusted accordingly. So that would be the transactions with regards to returns. And then if you pay, when you paid off your accounts, did you pay in time? And if you didn't get the accounts, then you'd be accounts payable and cash. And then if you paid and you got the discount, it'd be accounts payable because you're paying it off. You're going to get an adjustment made because of the inventory, because of the discount. So now your inventory isn't, you're not going to pay as much as you originally. So you got like a 5 or 10% discount because you paid in time, and then you paid with cash. All right. And those all fall under the buyer. Now, if you're the seller, let's look at the scenarios. So cash and sales, because you made inventory, right? You made some sales revenue, so sales. The next one would be the same thing, but instead of paying cash, right, it was on account, so it'd be accounts receivable because someone still owes money, but it's still a sale, so you still made the sale, so it's still sales. right? So we went through those transactions. If you're selling an item, right, people either pay by cash or they paid on an account. Then if they return, so this is where the sales return allowances that the other video explains. And again, it's that new account that allows us to balance it out. Instead of it being cash, sales return allowances goes under there because it gets labeled for return. And the same thing goes with if it's for an allowance. If it's a credit, the exact same thing happens on those accounts. So these two accounts are the same as they are with these two. These are the same. And these two are the same. The return process does not matter, okay, when we're following the dollar. It will vary when we're talking about the inventory. That's where it changes because there's no return of the actual product. So here we're looking at the cash. So did we receive a discount? No. So we received the cash would go up, and accounts receivable. And the same thing there is if because we received the money, right? Well, people no longer owe us money, so our accounts receivable, and they convert it to cash. So if they paid and they got the discount, I just realized I didn't do that. Got the discount. Cash would be one, but they got a discount, right? So we need to put that in there so they're not paying the full amount. So this would be sales discount. And accounts receivable because it needs to be adjusted. So they get the discount. So this is a new one. So sales discount and sales return allowance. And those are the two accounts that we're using. So that's when we're tracking the dollars, right? Both of these are respects to the dollars, where the money is going. Both of these are the same. The only thing that we're looking at merchandising is the track of inventory or product. So when you're looking at product, let's look at what's going on. So that may help. So product, there's just the two accounts, cost of goods sold and inventory. And the other video talks specifically into regards to cost of goods sold and inventory, but let's look at that. So when we're looking at the product, with this scenario one, it's cost of goods sold and inventory. When we're following, this also falls under the seller scenario when you're the seller. Put this up here as well. Okay, because it changes, it gets adjusted, right? Bought with cash or sell, so product's actually moving. Does product move on scenario number two? Yes, so it's the exact same. And remember, cost of goods sold and inventory are always the same. They always stick together. There's no one over there, so they're always together. If there's inventory, then there's cost of goods sold. Return for cash. Is product moving in that case? Yes, the product's actually going back, so it gets adjusted. So there will be that in there as well if you're the seller. So someone brings back some items. Return for allowance. So this is where it's not worth for them to ship it back. So they'll offer you a discount. So in this case, there is none because inventory doesn't move, so therefore the cost of goods goes. So there's no movement of product within these four scenarios. Only these three only. Right? If you think of your bought or sell product, it's going somewhere. If you're buying or selling something on account, it's how you paid for it varies, but it transfers hands. When you're returning something for cash, it changes hands as well. When you're returning for allowance, it's not. The product is staying. Whoever, if you're the buyer or you're the seller in this case, the buyer would keep the product and you're going to offer a discount. So the inventory doesn't change, and that's when the SRA falls into place. So we're offering a discount. And the same thing here. So when you're paying, this is just from a financial standpoint. So there's no transfer of product here, and there's none here. So I hope that helps help explain it a little bit as to once you determine if you're the buyer or the seller, which accounts are being used. So these two here are going to be the seller accounts. right? Once you determine whether the transaction, if you were the buyer or the seller. So, for example, in this one here, you you sell product for cash, cash would be affected, sales would be affected, cost of goods would be affected, and inventory. So all four of these would be included. Okay, so these would be as 4 accounts. These 4 would be account, and these 4. Okay, but only when you're the seller. All right. I hope that helps. So there's the next video, couple of videos. One we're going to go through, and Colleen's going to explain more detail, walking through the scenarios, and then there's another video which goes through actual transactions. So hopefully that helps.